Hello, everyone. Hope everyone's having a great day. One of the advantages here in Northeast Ohio, when it gets down into the 0 range, for some reason that's the only sunny days in the wintertime. This high pressure system comes in. We get to see the sunshine, even though you get frostbit in 5 seconds with skin exposed outside, you still see the sun. So here we are. Great to have everybody on the call. We've got some awesome folks from Shaker Investments on the call with us today. Advisors, you asked and we listened. You've been asking for boutique managers to be added to our platform. And as a lot of you know, when we launched into the space, we only had our own proprietary strategies. We build our own kind of off-the-shelf sleeves of SMAs, stocks, bonds. We have some ETF and mutual fund sleeves, but they were all created by the team at Revisor, which we think that they are, great options. But our mission has been to add other money managers to the platform. So that's been a huge initiative for us in 2025. And one of the really, really specific requests that has come from many advisors has been, we want to see some boutique options in the SMA space. We know about Capital Group and Zacks and Vanguard and Alliance Bernstein, you name it. But we want some of these smaller boutique shops that have done a great job and have great performance and have a great team. And so we've been going hard to the hoop to get those in place. And here we go today. We've got these folks are right in our backyard, by the way. So the Shaker team is right here in Northeast Ohio. We've got the luxury of meeting them in person, talking to them and essentially the entire team several times over the last few weeks, and just such an awesome group of people. They've had great results, and they're very, very well known for their small cap SMA. So we're gonna be diving in there today. We're gonna have kind of a conversational format. I'm gonna moderate, and I think we're ready. To get rocking and rolling here, Shaker team. So I thought we could maybe start. I know you guys have a slide deck that I'm sure that we will reference. But why don't we start with just why Shaker? I'm an investment advisor. I've got to build out this asset allocation, and I come to the small cap, the small cap part of the pie chart. And here we are. I have to decide between active versus passive approaches and all of those different things to consider. Tell us a little bit about Shaker. Tell us about your team. Tell us about we think you're awesome, but let's get the point across to everyone on the call today.
Great. Yeah, I can kick things off. So Brandon Hellegarn, a Chief Investment Officer at Shaker, joined by my colleagues Sasha Kostadinov, who's the co-portfolio manager with me on the small cap strategy at Shaker, and Anthony Panuto, our Chief Market Strategist at Shaker. So just a quick overview on Shaker. So we've been around since 1991, so almost 35 years. I think that's one of the differentiators. Not too many asset managers and folks picking individual stocks that stick around for that long. So we've seen a lot of different stocks, a lot of different markets, a lot of different environments, and I think that those lessons learned over time really position us well for our clients and for us going forward. Another thing, we've been focused on the small cap space for all that time. So again, we've become small cap specialists. And we've got a pretty robust team as we're looking at the space. We've got 7 folks on the research side, digging into these small cap companies. And I think compared to other firms of our size, that's pretty unique. And just the number of companies we're able to get to every single earnings season, week to week, and that breadth of coverage really differentiates us. So right now we manage 3 different strategies. We're going to talk about our small cap strategy today, which again, across all 3 of our strategies, we're really focused on small caps. The other 2 strategies, we also mix in some larger cap names. We own the Magnificent Seven, a lot of other names you're familiar with, but where we think we're going to really differentiate is in that small cap space, which with our research capabilities. We manage about $300 million in assets across the 3 strategies. And another big differentiator we think is of those assets, about 25% of them are Shaker employee assets. So we eat our own cooking. We are invested right alongside our clients, and we are really focused on returns and prioritizing that for ourselves and our clients.
Brandon, I love that, by the way. That was one of the big things when we heard the story, because that's always like just a fundamental proof is in the pudding kind of a data point, which we preach that as well. We do the same thing. We eat our own cooking, and I love that part of the story. So, anyways, that's awesome in my opinion. Big thing, big takeaway. But proceed.
Yeah, no, so absolutely. I think that's the quick overview. And for the great asset managers out there, I think that's a particularly important thing. And I'm just making sure those incentives aligned, and that we are waking up every day focused on that, and everybody's working towards that same goal for performance. Um, so um, so as we get into the go a little bit further with 1991, like I mentioned, Shaker has been around for 35 years. The founder is Edward Humlegarn. So the top left of this page, showing the investment team and the team overall. So that's my father. You may recognize the the same last names. So I grew up. We were talking stocks around the kitchen table, and have always been interested in the markets myself. But I joined the firm in 2012, and I've been the chief investment officer since 2020.
And now your brother Chris has joined the team as well, correct?
That's correct. So we got a number of Hologuns there, and another differentiator for the team is, frankly, look at the number of years that we've all worked together. For the average member of the investment team, we've worked together for 10 plus years. Edward and Ray have been around together since the 90s, since the beginning, and so I think that ability to collaborate and work together really helps us as we're working through some of the questions and the strategy as we dig into the markets and the stocks.
It says a lot about you as a family as well. You guys all work together, enjoy working together. That's pretty awesome in and of itself. So
Yes, it's always interesting for the Thanksgiving and Christmas and all that stuff. We end up talking stocks a lot of time, so
Nope.
it's good.
Awesome.
Well,
So anything else about Shaker? Just anything else that you'd like to throw out there? You, Sasha, anybody?
Well, we got lots of stuff. I mean, you want to whip through the slides, or do you want us to just talk, to shoot off the cuff?
No,
Let's
we can
let's
definitely. I looked over the slideshow a couple.
okay.
I read it like 3 times, and
Okay. Did everyone
it's
get it ahead of time?
I believe so. I believe every one of this has been distributed. Yes.
Okay. Well, we made a little pitch for why small caps, and then I'm going to cover why Shaker kind of at the end, how we do things. You want to zip through the why small caps, Brandon, and then we'll.
yeah, if it works for you,
Yeah.
Landon, we
Yeah.
we
Yeah,
put together a
please.
presentation walking through a few
Yeah.
different points, and some of these charts might help for explaining this. Visuals are always helpful.
100%.
So trying to answer some questions for all the folks on the call, why we think small caps are interesting, why we think active management is particularly important in small caps. I'll walk through some of those highlights. Anthony will talk through where do we sit January 2026, what's that setup as we're looking a little near term over the next year and into 2026. And Sasha can cover why Shaker in particular we think can really help in looking at small caps and active management in the space. If that works.
That sounds great.
Right, and please jump in, Landon or others. I think you can submit questions through the chat if you've got any questions on any of these slides. It's always great to stress test our ideas and our thought process internally. We love getting good questions. But I think as Landon mentioned at the beginning, we'll have some time for Q&A at the end as well. So kicking things off, why small caps? So there's been a lot of headlines, a lot of news reports. This has been going on for a couple of years. The concentration in the market, the Mag 7, the top 10 stocks, the mega caps driving everything, which we do think that has admittedly raised some risks in the market. You look at those top 10 stocks, close to 40% of the S&P 500. You look at tech and comm services. If you put the kind of tech adjacent names like Amazon in there, Google, or that aren't officially classified in the S&P 500 as tech, that gets close to 50% of the S&P 500, where there are some concentration risks, and a lot of it's dependent on this AI story that we've been hearing so much about for years and years. And we own those companies as well. We think they are fantastic companies, and they are delivering phenomenal returns for their shareholders. But as we think about some of the risks with the concentration, diversification, we think will be the name of the game, going forward, where it's really benefited that concentration in those top mega cap names the last few years. We think as we look forward to the next few years, diversifying will help, investors, given where we sit with valuations, given where we sit with the concentration in these mega caps in the S&P 500. And so this first chart shows, thinking about diversification, different asset classes. So you can see the great performance of large cap stocks. This is going back to 1987. We see gold, commodities have been doing a lot better lately. Foreign stocks, 2025, we saw, foreign stocks, both developed and emerging markets, lead the U.S. markets. A lot of opportunities there. But when you look over the long term, what has been diversifier, delivered those returns, it has been small cap stocks. Not to say that you shouldn't also be participating in some of these other asset classes, gold, foreign stocks, and certainly keeping, a large chunk of assets in large caps. But thinking about that diversification, where maybe increasing some of these exposures to these other areas, and small caps can be a great piece of that puzzle for your clients. So that kind of sums up this slide.
Am I safe in saying on that, Brandon, when I look down here, starting in outside of 2022 through current, small cap really, slightly outperforming large cap. And it wasn't until these last few years, the Mag 7, that whole AI high tech story, where large cap has taken off and gone nuts. But it doesn't always continue in that same direction, right?
Absolutely. I mean, if you go back through, this chart goes back to 1987. If you went back a lot further, you go to 100-year history. There's the small cap premium in markets. Plenty of academics have written about that over the years. And frankly, it was, larger historically, and we've seen some compression in large cap outperformance, as you can see in this chart. Where it's a question of will we revert back to those historical trends where there is that small cap premium? We think a strong case can be made for that. But at the very least, I think it's unsustainable, just efficiency of markets, that these large cap names will continue to outperform forever, that there will be cycles. And as we get into this next slide, here is showing that cycles of small caps versus large cap performance. This is going back to the 1980s again. So this is that stretch where there hasn't been that small cap premium as much, but there have been these cycles. So you can see these cycles lasted 5, 10, 15 years. Unfortunately, no hard, exact number that you can pinpoint for when to flip from large caps to small caps. But you can see going back to the early 2010s, mid 2010s, this is the small cap relative to large cap performance. We've been through this, pretty strong performance of large caps, or small caps underperforming large caps. There's a brief cycle post-COVID where, 2020, 2021, there was dramatic outperformance in the small cap space. But, going back further in the 90s, we saw large cap outperformance followed by through the 2000s, shifting back into small caps. And we think, there are some early signs that this has been going on long enough, 15 years historically. This is how long some of these cycles have lasted. That and in the last 6 months, starting to see, small caps beginning to outperform. It's looking more encouraging for the first time in several years. And we think this could be the beginning of one of those small cap cycles as we're looking forward to the next 5, 10 years. Now, it's hard to pinpoint exactly when the turning point will be, but there are some signs that this could be it. We have a lot more conviction as we're thinking about the next 5, 10-year forward returns, given where valuations are set up, which we get into the next slide. But there are some signs that 2026 and maybe on the beginning of that. But even if it's not this year, we do think over the next several years, we're going to see that cycle shift. So where I mentioned valuation setup, and this historically, some of these cycles has been a driver. You can go back to the late 90s, 2000. This was another signal that indicated that shift into the 2000 period when small caps began to outperform, is the valuation gap of large cap stocks versus small cap stocks. So the S&P 500, the forward P right now about 22 times, historically pretty elevated. You look at this chart going back to 2000. This is, it got there in early 2020s, right out of COVID. And then the last time it was there was the 1990s, the tech bubble. And then by comparison, you've got small and mid cap stocks, the S&P 400 and the S&P 600 in that 15, 16 times range. So, and which is that kind of average, a little below average of where it's traded over the last 25 years. So what's been driving this large cap outperformance for the last 15 years? You can see the PE. It's gone from about 12 times in 2012 up to 22 times. That's been driving these phenomenal returns we've all seen in the S&P 500. It's going to be hard to sustain that given where we sit today at 22 times. By comparison, I think there's a lot more opportunity in the small cap space at this 15, 16 times level. Any questions there?
You may have a slide coming up on this,
Mhm.
Brandon, anyways, but do you feel like in general, I know that do-it-yourselfer investors do this, but sometimes I feel like a lot of financial advisors do what I'm about to explain. If I saw one of the future slides correctly, there's been a net outflow from small cap funds in recent times, correct? In the last
Yeah, absolutely.
few years.
We can dive into that next. So that gave the little longer term picture why we're so confident when we think about the next 5, 10 years. But how does that help us in 2026 as we're thinking, it's hard to position today for 2030, and so what gives us some kind of signs that maybe 2026 is the year when things are more interesting in the small cap space? Because it's been several years that people have been calling for a turn and beginning of small cap outperformance. One, this slide 8 here, we've started to see small cap earnings estimates move higher, which they were just kind of flatlining for the prior 2 years. And then about 6 months ago, and while you see large cap earnings, goes back to 2022, they, it's growing at a pretty nice clip. Stronger earnings translates to stronger stock performance. And in the last 6 months, we've seen small caps and mid caps. This is again adding up consensus estimates. They've started to participate with earnings estimates rising. So fundamentals are finally starting to get better in that small and mid cap space over the last 6 months after stagnating for the prior couple of years. And then going into, as you alluded to, these flows thing. This is another data point that gets us pretty excited on the next slide, where in 2025, for the first time since 2011, there was an outflow in small cap ETFs. You add up all the small cap focused ETFs, and normally, money's flowing into equities. There's a positive flow into these ETF assets. And for the first time since 2011, there was an outflow in the year 2025, which is a signal for where sentiment sits right now. This is a space that investors are kind of ignoring, at this point, and it's left for dead and this washout, that type of talk. Those are the setups that can be very interesting as you look for the next couple of years when investors have abandoned a space, valuation looking more attractive. Combine that with an improving fundamental backdrop, and historically we found that can be a great time to really start digging into and getting invested in an area of the market where there can be a lot of opportunity.
I love it because we see a lot of advisors chasing the trend, right? So we preach this contrarian type of a mindset from a macro portfolio management perspective. We have a lot of advisors that tactically they have us or they themselves make tactical moves within that pie chart, right? And we'll be preaching something like, yeah, whether it's a duration change in bonds or a flip in the percentage and heavier weighting small cap versus large. And the advisors say, are you crazy? It's all about large cap right now. And we go, that's going to change. And we don't know exactly when that's going to flip. But we've had a lot of success in our tactical moves in making those flips and not waiting until we're, jumping on the caboose and we've already lost the opportunity. And do you feel like that's at kind of like the heart of the outflows? It's just people chasing the currently hot large cap Mag 7 type of investment structure?
I certainly think that's one of the contributing factors. Absolutely. And it's hard to pinpoint one thing. The markets are very complicated, but absolutely agree with what you're saying that, investors will always chase returns and performance. And frankly, you could look at small caps year to date of some of these transitions happen faster than you think of small caps. We put a lot of these slides together before at the beginning of the year, a couple of weeks ago. But, as we sit here now, it's small caps are, up 5-6% range. I think midday, last I checked, versus large caps flat to slightly down where, there is beginning to see some signs of, inflows. Presumably, I would assume if we see that chart in January with those returns would translate into some positive inflows in the ETF space. And But we think we're pretty early in that. We are thinking about it more in a 1, 2, 3, 4 year picture as we're thinking about these charts. But some positive data points that get us more excited as we think about the near-term future.
Absolutely. And I see your next slide, we're moving into the active management conversation. There, of all the advisors on this call and the folks that will, let's say, that we're going to send this out to, and we'll continue to use this interview as just a tool to educate the advisors we work with, and so on and so forth. But a lot of the folks that we work with are just getting them comfortable with paying a higher expense ratio for active management is a struggle at times. And the conversation we always have is we're very cognizant of fees. If we can pay 3 basis points for a passive ETF, okay, great. But the net result is what everybody is interested in. And one of the conversations I've had recently with an advisor was just the concept of, if you've mentally made the choice that passive is the only way because of the cost reduction, have you looked into that concept in every single asset class? Have you considered the possibility that maybe part of your pie chart could be passive and part of the pie chart could be active? Like in this example, it makes sense to me. It makes a lot of sense to consider active management and paying that extra cost to have a very reputable and accomplished active manager actively manage a small cap portfolio. So it looks like we're about to start going down that path, obviously, and looking forward to hearing your take on the active approach, brother.
Absolutely, yeah, and we certainly, fees are critical. We are advisors as well. We've got a lot of individual clients as well, and fees are critical. We want to make sure we are delivering that performance net of our fees. And if we can't do that, then passive is certainly a great option for individual investors and institutional investors. What we think in the small cap space, though, anybody can invest in Nvidia and Google, and so passive. It's hard to differentiate from passive in that large cap space. But in small caps, there's a lot more companies. There's 2,000 companies in the Russell 2000, and this chart shows a lot of those companies. There tends to be a much bigger dispersion in terms of quality versus the large cap space, and that's where active management can really help differentiate. So this is something we've seen. We've been in business since the 90s, and we've seen markets change since the 90s. This is one of those charts that really exemplifies that. In the Russell 2000, so the small cap space, they're now 40% of the companies in that small cap benchmark are unprofitable. Where there is a lot of lower quality companies versus S&P 500, there are profit requirements to get put in the index. To get to that scale and size, you need to have profits to grow. But in the small cap space, there can be a lot more dispersion, and we think active managers can really help differentiate what are the quality companies versus what are some of the junkier companies or lower quality companies. And it's those quality companies, if you look at over time, those are the ones that deliver stock performance over the long term. There can be periods of lower quality outperformance, but if you look at longer term periods, multi-year periods, quality, profitability, those are all factors. Academics have shown this, market practitioners, people participating, show this over the long term. You want to own those companies that are generating those profits, generating those, great fundamental performance. Those are the ones that outperform. And we, with our 7-person research team, we can dig through all those 2,000 companies in the small cap space. It's hard for a lot of folks to do that because you're managing a lot of your clients. You're, trying to cover everything and fixed income and international and large caps, and we can really hone in and focus on the small cap space and help other advisors that way. So we go to the next slide, and you can see, as I talked about, where quality. This is a chart going back to 2005. This compares high quality versus low quality companies in a study, but over time, quality tends to outperform. You can find a lot of these charts by other researchers on the sell side in academics. Companies that are generating higher return on capital, generating higher return on equity, showing growing earnings. Those are the ones that tend to outperform over the long term. Now, as I mentioned, you do go into some periods of, they can be shorter term periods, 6 months a year, where there's lower quality outperformance. And frankly, one of the reasons we get excited about our approach is we've just been through one of those periods. So coming out of the April 2025 lows after Liberation Day, market had sold off, and we see this a lot of times with big market sell-offs. Then the recovery, the initial recovery, we see a lot of pretty strong returns we've seen going back to April over the last 8 months. They often tend to be lower quality rallies. The stuff that got sold off the most tends to bounce back the most, and we've seen that. But eventually, as you get into that second year, third year, companies need to deliver on fundamentals. And we've seen this happen coming out of prior downturns and recessions when there is more of a fundamental impact where earnings have dipped and then recover. It eventually, first year tends to be some of this lower quality that outperforms. Stuff had gotten so cheap that then it just snaps back. But then it transitions into these higher quality companies that really deliver as they report earnings, deliver that earnings growth, deliver those cash flows to shareholders. Those are the ones that over time end up performing. We think those are more attractively valued now after we've seen this outperformance in lower quality stocks. And as we look at these higher quality companies, that's what we tend to really focus on and do our fundamental screens on and our homework on. We're seeing a lot more attractive valuation opportunities compared to other spots in the small cap space as we sit here today.
Love it.
And then, so I'm going to turn it over to Anthony Panuto, our Chief Market Strategist, and he'll talk about a little more. We're sitting here January 2026. What are some of the signals we're seeing in the market? What's the setup as we look forward into the rest of 2026 and as we sit here today? So,
great. Thanks, Brandon.
Thanks, Brandon. Hi, everybody. I'm going to just kind of go over a few slides. These are just a few things that we look at to help give us a temperature check of the market and the risk appetite for participants basically helps give us an idea of when we should be increasing our confidence to move further down the cap spectrum into the smaller cap stocks again after, as we've said, an elongated period of underperformance versus large caps. The first thing we're looking at here is the value line index, which for those unfamiliar, it's 1,700 of the largest U.S. traded equities, equal weighted and rebalanced daily. So long story short, it is a true look at the average stock on a day-to-day basis. And now this was printed as of January 6th, but I can tell you that we're near all-time highs still. We're still printing new all-time highs on this. So the average stock is doing very well and breaking out versus the cap-weighted S&P 500 index. And that is not something that we could have said over the last 3+ years. Another thing that helps us, kind of gauge the risk sentiment for small caps is market breadth, which the bottom pane kind of visualizes for you. This is the Russell 3000 number of stocks above their 200-day moving average, which is a simplistic view on trend. So essentially what we're saying is 63% of stocks in the Russell 3000 are in uptrends. And that is, counter to, and I know the narrative has started changing, that it's not just all Mag 7, it's not just all tech. We've been, internally watching for 6+ months how things have been changing. Going back, to look at kind of comparing various sectors to kind of, continue down our path to figure out, how real the change is in risk sentiment and how the market is broadening out. What we look at here to gauge it is equal weighted discretionary versus consumer staples. Now, why equal weight is important is because obviously we want to neutralize things like Walmart, Costco, Amazon, and the like. And you can see the average discretionary stock is breaking out to new highs versus the average staple stock, a sign of a very healthy market. Also can be said for equal weight technology. That goes without saying, neutralizing the technology names versus equal weighted healthcare. That is also up and to the right. Things that you see along with broadening breadth as a good sign that sentiment is starting to shift in a meaningful way for small caps. And finally on this page, the banks, cap weighted banks versus the S&P 500 hitting cycle highs after its Silicon Valley, kind of really tanked the group. They got their footing rather quickly and have been repairing themselves and been market leaders since. And all of these things happening on this page do not happen in an unhealthy, concentrated, one-way market trade. So that is another thing that helps us know that we, it gives us, a feel that we can start branching out into more stocks in the mid and small cap range. And then finally, on the next page, what you'll see is just simply it's the Russell 2000. And then below that, in the second pane, is a Russell 2000 versus the S&P 500. Back in September, we hit a level that the S&P or that the Russell 2000 has hit a couple times over the last 5 years, and for lack of a better way of saying it, has failed it miserably and sold off pretty hard, all the while keeping that relative downtrend in place, where, quite frankly, it was unsustainable to generate alpha in small caps versus large. What happened in September is very different in our eyes. As we continue to get more information, we see new highs breaking out. We've seen a consolidation. We've seen new highs after that, and all the while, we were finally seeing a meaningful 6+ month bottom on the small cap versus large cap relative trend line. And for us, and now obviously when things change, we will change. But right now, this is the most meaningful setup that we've seen for small caps versus large in 5+ years. And that, I think, is where I'm going to leave it. This is just kind of a snapshot of what we're following. Brandon covered the fundamentals, the E, if you will, and PE. And that's kind of what's going on with the P. And I'm going to throw it back to Brandon, and we'll take it from there.
Anthony, that was awesome, by the way, brother. I mean, that's like, again, none of us know exactly what's going to happen in the future, right? But that's a lot of data pointing to a shift. So
Yes.
That was great. Thank you.
Yeah, so Anthony did a great job covering some of those market signals from the technical analysis side of things that we're getting for, hopefully some signs, put the odds in our favor for where the market is headed. What we really like to do with the rest of our research team, we're focused on the fundamentals, looking at the companies, looking at the earnings trends, and if we can marry that and see market signals combined with positive trends there at attractive valuations, that's where we can really get more excited about our forecast. So jumping off of Anthony talked to the technicals, some fundamental signs that we're seeing that are getting us more encouraged as we look at a lot of these companies in the space. So this is since 2022. It's a little bit of a busy chart, but it shows earnings growth based on different segments of the market. So it's historical 2022 through the third quarter of 2025, and then in the future fourth quarter of 2025 and 2026 projected earnings based on analyst consensus on the sell side. And what you see is in 2023, 2024, and even in 2025, the only thing that was putting up tremendous earnings growth was the Mag 7, that blue line that kind of goes off the chart in 2023 and then as well above everything else in 24 and 25. Meanwhile, you've seen a bit of an earnings recession in the rest of the market, where we've got the S&P 493, the rest of the large caps, the mid cap 400, and the small caps. And Europe is also thrown in here with the stock 600. But those have just seen kind of earnings stagnation as we look at 2023, 24, 25. And then as we look forward, there is what current sell side, what Wall Street consensus is projecting is kind of a convergence. So we'll see an acceleration in small mid cap S&P 493 earnings and a bit of a deceleration, although still very strong growth out of the Magnificent Seven, getting into that 15 to 20% range. So as we look at that with valuation setup, the more attractive valuation as we look at the non-Mag 7 parts of the market combined with the accelerating growth, that's where we think there could be more opportunity. There may be more opportunities, elsewhere in the market, and why we are more interested in that mid and small cap space. Now, these are current consensus estimates. They could be wrong. People were forecasting a similar trend last year, and it ended up that those mega caps still delivered on earnings at a much faster rate than the small and mid cap space. But earlier chart we showed, There have been, in the last 6 months, some more encouraging signs that we didn't see a year or two ago with accelerated earnings forecast as we look at the rest of the market, combined with some monetary and fiscal stimulus signals that should lead to broader economic growth, and that tends to be much better for the rest of the market of broadening out. As Anthony was alluding to, that we're seeing in the technicals, we're seeing reasons in the fundamentals why this should occur and translate into earnings growth. So there has been monetary stimulus for the last couple of years. The Fed has cut 175 basis points since September of 2024. That stuff takes some time to work through the system, usually 12, 18, 24 months. So now is when we're at the beginning of when that stimulus should be benefiting economic growth and PMIs. That tends to translate to more cyclical names, a lot of those being in the small and mid-cap space, seeing some tailwinds. And it's not just the Fed. It's, if you look, central banks around the world have been stimulating, and that's what this top left chart shows. Combine that with there has been fiscal stimulus, not just in the US with the OBBB, which should lead to some tailwinds on the tax front as we get into tax return season and withholdings in 2026. But you're seeing similar stimulus in Japan and Germany. So a lot of these signs that are pointing to we should see better economic growth, and we're seeing that at the same time as we're seeing better stock performance in the small and mid-cap space, and all this should translate into better earnings growth in the small and mid-cap space is our forecast. So that is how we see the world as we're sitting in 2026. Why we think small caps in general are interesting. I'm going to turn it over to Sasha about why we think Shaker in particular can help you in the small cap space and give a little more information about our small cap strategy.
Love it. Thank you.
Yeah. Thanks, Brandon. So what I'll try to do is give you an overview of how we manage the portfolio to give you some comfort as to why you might want to go with an active small cap manager like us. So I co-manage the small cap growth portfolio. Over the next 4 slides, this will be a high-level overview of how we manage the portfolio. The key point of our investment philosophy is that we research every stock we own, which is based on the belief that disciplined fundamental research is the foundation for long-term outperformance. We have, not including Anthony, who does a great job on the technical and market overview, is that we have 6 fundamental analysts, including portfolio managers, and one of those analysts covers each stock that we own. Before we add any stock to the portfolio, one of those analysts will present it to the investment committee, and the committee decides whether to buy the stock or pass on it. Once the stock is in the portfolio, assuming it makes it, the analyst assigned to that stock keeps tabs on the company. That includes updating our own internal earnings models, participating in conference calls or visits with management, monitoring relative news and events. There's certainly much more, but that's the gist of it. The key point is that we are keeping track of these companies ourselves. Okay, on the next slide, the key point is that we narrow the universe of investable stocks to exclude those that don't fit our criteria. As Brandon showed earlier, the quality of the Russell 2000 Growth Index and the Russell 2000 Index has declined over time. Benjamin Graham famously said, in the short run, the market is a voting machine, in the long run is a weighing machine. That's what our investment process strives to do. We are attempting to weigh these stocks. And the key sauce to that is on the next slide. An investable stock is one that meets most of our 11 criteria, though not all stocks are a perfect 11 for 11. On the left are 6 traits that are somewhat subjective. That's where the analyst experience is leaned on. I'm going to touch on a few of the criteria, but feel free to submit a question if we don't cover one you're interested in. Also, at the end of the presentation, we've included a specific example that we can review if there's time and interest. But here, I'll just go over a few of them. Why new product development? This one is simple. Companies with new products grow faster. Why diverse customer base and products? This one's also simple because companies that have many customers and products or services are less likely to suffer a significant customer loss or be forced to reduce their margins to keep an important customer happy. Assessing if a company has a sustainable advantage. This is probably one of the most important and most difficult criteria, so we spend considerable time on it. The investment committee tends to be tough on this criteria, often challenging the analyst's own assessment. On the right side, we can give you some numbers, and here are some numbers. The 5-year sales growth for the portfolio is 19% versus 11% for the S&P 600, which is a comparable quality small cap benchmark. The 5-year EPS growth for the portfolio is 19% versus 7% for the S&P 600. The return on invested capital for the portfolio is 15.1% versus 6.8% for the S&P 600. And then here's kind of a more intangible item. We were talking about Shaker being invested in our own products. We also like to invest in companies where the management owns their stock, and on average, portfolio insiders own 8.1% of the shares outstanding versus 4.2% for the S&P 500. So the companies in the portfolio have a similar interest in owning what they're managing. Moving on to the portfolio construction, the portfolio itself typically holds 35 to 50 stocks, obviously a much smaller number than you see in the indexes. As you can see on the right, the top 10 positions currently comprise 40% of the portfolio. So this is not an index fund. That's reflected in our active share, which is 95%. The active share statistic ranges from 0 for a pure index fund to 100% for a pure active fund. So you can see we are not here trying to tell you that we're an active manager and are not an active manager. We are. Initial positions typically will be 1 to 2%, but we may add to a position as our conviction grows. And an important point is that we also let our winners run. So positions will become concentrated. We will reduce positions or sell them for fundamental reasons, such as valuation or a change in growth prospects, which is another differentiator. In terms of sector weights, we will monitor sector weights and strive to keep them in line with the benchmark. But again, we're not an index fund, so there could be variance. And that, in a nutshell, is how we manage the portfolio. We're an active manager, and we try to outperform the market with our own money. Thanks for your attention. I'll now toss it back to Brandon so he can conclude this and open it up for questions after he's done.
Thanks, Sasha.
Sure. Thanks, Sasha.
You're welcome.
So next chart is our Shaker small cap growth track record. This is going back to long-term track record since 2007. We've outperformed the small cap growth index as well as the small cap index. Like I said, we are investors in the strategy. We are focused on delivering performance, and this is all net of management fees and net of all fees and expenses. So we think that's important, and we try and deliver on what we say, and we're doing our best to do that. So
that's pretty awesome, by the way. I think that's one of the things all the advisors were anxious to see is what's the result, and it's a great story, and then it's matched with great results, and that's awesome. Congrats.
Thank you. So to summarize, we think it's a favorable setup for small caps from a diversification standpoint, looking to, given the concentration risks in the market at the large cap end of the spectrum, looking elsewhere, diversifying, we think will help investors over the next several years. We think small caps can be a great piece of that diversifying portfolio and still get some, over long term, pretty high returns relative to other asset classes based on the historical track record. We think active management can really help identify those quality companies in the small cap space. So active managers like Shaker, and we think separately managed accounts are a great way to do so. You get flexibility, transparency, tax advantages with separately managed accounts. That for Shaker, I think that we generally predominantly deliver long-term taxable gains, pretty minimal on the short term, just given the nature of our strategies. We're looking to invest for 2, 3, 4, 5 years in a lot of these stocks. We are long-term investors, which translates to long-term capital gains. And we have the long-term track record. We've been focused on small caps for 35 years. We think we've developed a niche and where we can add value for you and your clients. We think our process is repeatable, research focused, digging in the technicals as Anthony does, combined with fundamental work the rest of the research team does to find these companies that we think can deliver long-term outperformance. And as I said at the beginning, we're invested alongside our clients. 25% of our assets are Shaker employee assets, and we want to deliver for our clients as well as ourselves. So That's what I think differentiates us. Really appreciate the time and for listening today, and happy to answer questions from here.
Awesome. Yeah, thank you all. That was great. That SMA piece, I think and most of the advisors are already familiar with this, but it does come up in conversations a lot. We have no beef with ETFs and mutual funds. They have their place. But there's something, me as an investor myself, I love to be able to open my statement and actually see all the names that I own and easily see the names that I own and then see the changes that are made as adjustments get made. I mean, not that data can't be found in the ETF or mutual fund world. It's just it's a little difficult, as we all know, to get that level of transparency. And love that you all are still structured as an SMA. And gosh, just very impressive overall. So happy to have you all on. So yeah, let's open it up now for questions. I'm not sure. I haven't seen any. Eva, or Nick, whoever's handling the queue. Do we have any questions coming in from the audience?
Don't see any yet, but we'll give them a minute here. In the meantime, I've got a couple quick, just surface level questions that we can go over if that works for you guys. And as we
Sure.
go on, we'll probably get some more questions. First thing, so you mentioned letting your winners run and having high conviction in your positions. A lot of your portfolios in core positions, or what you would consider core positions. Do you guys have an estimate of your turnover ratio on a given year?
Ashley, you got that?
It varies year to year. It's about 50% typical
Okay.
year. Actually, maybe the stats for most recently.
That's what
No.
we strive for, as little as possible. But as Brandon points out, we have the specific statistics, like the last 5 years or 10 years. Yeah, Ashley could give you that. But we're not trying to trade. We're trying to trade as little as possible, which is
Okay,
another way to keep
ballpark.
the cost down.
Ballpark about 50% on average if you look at several years, and a lot of that ends. It's not names turning over. It's we try and tactically add or reduce positions over time that will hold the name for 3 to 4 or 5 years, but we will adjust the position size in any given year as we see tactical opportunities favoring one position versus another.
Absolutely. Let's see. Know that I see any others just yet.
I have a
got
very
one. It looks like someone might be having trouble with the Q&A piece here. I've got one of our advisors. Do you have a maximum nominal weight to a position, or just a plus or minus to the benchmark, or just additional weight or less weight to a benchmark?
Yeah, I mean, if you look at our current positions, pretty much we'll keep it. Our largest position right now is about 8%. That's probably about as high as we'd go.
Okay.
So we'll trim those positions as they bump up against that number. So that will add to the quote unquote turnover. But
And then we will look at relative weightings as well. Frankly, it's less of an issue in the small cap space. So, the top names in the Russell 2000 growth, which we use as our benchmark, are about 1%. Very rarely do they go much above that, or else they get bumped up into the mid and large cap indices.
Right.
So we in the small cap strategy, it's mainly focusing on absolute weightings versus. I think it's a little more important in the larger cap space when you've got names that are 6-7% positions in the benchmark that really have to keep a close eye on the relative side, that it can make a big difference.
Right, and as I said before, we pay attention to sectors, but we're not an index fund, so we're trying to keep the sectors relatively in line, but we're not doing it on a name by name basis. As Brandon pointed out, if you're in the S&P 500 and you have 5% in Microsoft, well then those managers make a decision: should we be 6% or 4%? We're not doing that. Clearly, you can see on our list, our top holdings are well out of alignment with the index weightings, and our active share being 95% tells you all you need to know.
Absolutely. Right. Looks like we've got our first question from an advisor here. So, and I think this is in the chat, so feel free to reference it directly, but I'll go on ahead and read it out. How would you answer a common rebuttal against small cap stock ETFs? For example, similar annual deviation to QQQ, but far less alpha in the past 20 years.
Yeah, I mean, I think this probably goes back to the question, or fact of the matter is small caps have underperformed for 15 years, and the Qs have outperformed the S&P 500. We showed the chart versus the S&P 500. It looks even worse versus the Qs, given the Qs have outperformed the S&P 500. I do question just with market efficiency and equity risk premium, are the Qs just going to forever outperform every single year, every single 5 years? That at some point, there will be cycles given where valuations get to, and then flows go back the other way, given markets are, there are inefficiencies. We think we can identify them on an individual company basis, but the structural I do wonder if, forever, perpetually the Qs can always outperform, hence why we think diversification, not saying sell all your, NASDAQ big winners, those are great companies as well. But as we look forward, given where valuation is, given this tremendous performance you've seen out of these tech high flyers for 20 years, and especially in the last few years, that on a go-forward basis, we think there may be more opportunities over the next 5 or 10 years elsewhere in the market.
Yeah, this isn't the first time that segments of the market have outperformed for long periods of time. You can go back further when, for instance, the railroad stocks were leading the market, and nobody questioned why, and everybody wondered why you should own anything besides railroad stocks. That's something that we're not going to tell you when to make that decision, but we're trying to make the case that if you do want to spread your bets a little bit and find a portfolio that actually, on a fundamental basis, even though it is a small cap portfolio, compares quite favorably to the S&P 500 in terms of growth. Slightly less return on invested capital, but that not on an equal weighted basis. That's on a market cap weighted basis. So, but that's a good question, and that is the $64,000 question. When will small cap start to outperform? Who knows? Who knows the answer to that?
But
we try to make a case.
Yeah, and the diversification argument is huge, and it's depends on the audience, right? If we're talking to a group of 20-something-year-olds that are investing their excess cash flow from part-time work as they're in college, they might have 100% of their assets in speculative crypto holdings, right? And that might make sense for them. But the majority of us are managing capital for people where they want growth, but preservation of capital and a reduction of volatility is a huge thing for them. So at the end of the day, yeah, I'm sure there's an audience somewhere that has a huge appetite for risk and can just concentrate into one particular area.
Yeah.
But for what most of us do, we need this diversification component and this zigging and zagging concept in order to keep our clients from jumping off the ledge.
Yeah, well, that's it. We're not trying to make the case that you shouldn't be in those large cap tech stocks. Clearly you should be, but we're making the case, and we are as well. We have other portfolios at Shaker Investments, but we're making the case, at least based on what we're looking at, that small caps offer some advantages right now.
Yeah, and it's worth pointing out too that one of the strongest forces in the markets, aside from compounding, is reversion to the mean. And the stat that you quoted in the question itself kind of answers that for you. It's been 20 strong years for the Qs, and we have really moved into a world where there are a lot of funds that are flowing into passive investments. And quite frankly, that means a lot of funds can reallocate very quickly. So as the Qs become a bigger part of your 401ks, your IRAs, it would go back to the diversification point, is that if you're putting together a diversified portfolio, tactically pulling some from the Qs, and looking for some small under-followed names that could turn into mid and large caps is probably a good strategy for anybody who's got themselves a diversified portfolio.
Yeah, that's a great point, Anthony. And I'll make one last point, and that's, if you look at rolling 1 or 2 or 3 year returns in any asset class, it looks very, very random. But if you look at cumulative returns over longer periods of time, like 10 years, it is remarkable that the best performing asset class over a trailing 10-year period typically comes back to earth over the subsequent 10 years. Anthony referenced the term reversion to the mean. That's all that means, because otherwise, at some point, NVIDIA and the rest would be, 100% of the market cap if this trend continued for another 10 years. So.
And to be clear, we're not calling for a crash
Yes.
or
No.
negative returns
No.
in large cap space. Just we've had this great stretch of 15-20% returns for years and years and years in large caps in the Qs, or might be a little better than that in the Qs, that we don't think that's going to repeat for the next 10 years. We think you're more likely to get historical close to the average of that 10%, or maybe 5 to 10% if there is some mean reversion. Not that it's going to be negative. You'll still be getting positive returns as you think about, but just that it's unlikely to sustain at such a rapid clip that all of us have invested in the markets have appreciated for the last 10 years, and that is the case we're making. Oh, I think you might be
You're
on
muted.
mute.
You're muted.
Oh, sorry. I said awesome. I was just saying awesome. Thanks, everyone. I don't know if do you have any other lingering questions that we can take here in these last couple of minutes, Nick, or was that the last one?
I've got one other one here that I want to cover. I got this from someone who was also having a little bit of trouble with the Q&A function. And they were asking, how do we get access? Do we have to open one account with this strategy? Can we blend with other strategies we are currently using? And I think that's more of a question for us in this context. And the answer is, you don't have to open a new account. We can blend this with current strategies that you're using.
Yep. That's the platform side of this whole arrangement. The Revisor platform makes all of this significantly easier to get access and just diversify. Pretty easy to get your clients' funds headed this direction. So let us know if you're interested, and we'll make it happen. Very easy. Awesome. Well, thanks, everyone. We're coming up to the end of the hour here. I thought that was great. Shaker team, you do a great job of presenting your strategy. Bunch of great folks. We appreciate your time.
Thank you.
Thanks
for having us.
Thanks, everyone, for the time.
Absolutely. Bye-bye.
Bye.
Be well.